Understanding portfolio managers, roles, responsibilities, and strategies. What is a portfolio manager? A portfolio manager is a financial expert responsible for making investment decisions on behalf of individual or institutional investors. Their role involves developing and implementing comprehensive investment strategies to manage asset portfolios effectively. These professionals aim to maximize returns while minimizing risks, which requires a deep understanding of market trends, asset valuation, and investment strategies. Key takeaways. Portfolio managers make decisions based on specific investment strategies. They are responsible for the day-to-day management of assets, ensuring timely trades and adjustments to portfolios. They can adopt either an active or passive management style, influencing the potential returns of the funds they oversee. Success factors for portfolio managers include research abilities, market insight, and the capacity to generate innovative investment ideas. Duties and responsibilities. Portfolio managers engage in various essential activities that contribute to effective portfolio management. Their responsibilities typically include 1. Investment strategy development. They create investment strategies tailored to the needs and goals of their clients or funds they manage. Common strategies include buy and hold, maintaining investments for the long term to benefit from potential appreciation. Value investing, identifying undervalued stocks to purchase and hold until they reach their intrinsic value. Indexing, creating portfolios that mimic the performance of specific market indexes. Income investing, focusing on securities that provide regular income, such as dividends or interest. Active investing, frequently trading assets to outperform the market. 2. Research and analysis. Portfolio managers conduct thorough market research and analysis to understand market trends and identify investment opportunities. This research may involve analyzing economic indicators, corporate financials, and industry developments. 3. Portfolio monitoring and rebalancing. They continuously monitor the portfolios they manage, making necessary adjustments based on changing market conditions, investment performance, or shifts in their clients' financial goals. 4. Communication with investors. Keeping clients informed about portfolio performance and investment strategies is crucial. This may involve regular meetings, reports, and updates. 5. Collaboration with investment teams. Senior portfolio managers often work closely with investment analysts and teams, guiding them in research and investment selection. Compensation structure. Portfolio managers may have diverse compensation structures, including base salaries, performance-based bonuses, and commissions. The variability depends on the firm and the type of management style, active or passive, they employ. In active funds, portfolio managers might earn a larger bonus based on their fund's performance. Types of portfolio managers. Portfolio managers generally fall into one of two categories based on their investment approach, active or passive. Active portfolio managers. Active portfolio managers adopt a proactive strategy, aiming to outperform the market through frequent buying and selling of assets. Characteristics. They regularly analyze market conditions and seek to capitalize on short-term price movements. An active management strategy may involve hands-on trading, sector rotation, and maintaining a diversified portfolio to mitigate risks. Performance. Historical data show that only a small percentage of active portfolio managers consistently outperform benchmarks, making this a high-risk, high-reward approach. Investor considerations. Investors seeking to engage with active management should carefully examine fund marketing materials and performance records, as these can provide insights into the manager's investment philosophy and track record. Passive portfolio managers. In contrast, passive portfolio managers seek to replicate the performance of a specific market index, such as the S&P 500. Characteristics. They employ a hands-off approach, focusing on minimizing trading costs and tracking their benchmark index closely. Passive strategies often involve investing in exchange-traded funds, ETFs, or index funds that automatically adjust to reflect changes in the underlying index. Performance. Passive managers typically deliver returns that closely align with market averages over time, appealing to investors seeking stable, long-term growth without the fees associated with active management. Experience. The experience level of passive managers can vary widely, but the approach generally requires less frequent trading and oversight than active management. Conclusion. Portfolio managers play a crucial role in the investment landscape, acting as stewards of investor capital. Their expertise in developing and implementing investment strategies can significantly influence the performance of individual and institutional investments. As investors seek to balance risk and return in their portfolios, understanding the distinctions between active and passive management, alongside the responsibilities of portfolio managers, can help them make informed decisions aligned with their financial goals. Whether one opts for an active or passive strategy, the choice of a qualified portfolio manager remains essential for successful investment outcomes.